One of the three areas I consider to be a more common way to invest your savings, as I said, is stocks and bonds via the public markets. And so what do I mean by that? Stocks, if you don't know, are essentially buying shares in publicly traded companies. So businesses out there, in America, Apple's, Tesla's, whatever, you buy a small share in the company and essentially you're an owner, part owner, and you share in the profits, either via the equity growth of the stock or dividends that the stock might offer, or both. And you can invest in stocks both domestically here in the US or internationally around the world. And you might do a combination of both. Now, bonds are probably the most common addition to public markets investing. And often bonds and stocks are put together as sort of a combination of an overall portfolio by, financial managers around the world. Bonds, if you're not particularly aware, are essentially you giving out a loan, right? So bonds range, from the most simple U.S. Treasuries. You're giving a loan to the U.S. government so they can go spend money on whatever it is they need to spend money on. Essentially, if they don't have the money from taxes, they borrow money through treasuries so that they can buy more stuff. And all that debt that you hear about, the national debt, those are basically a sum total of all the treasuries and other bonds the government has issued, and people have essentially said, hey, I'll let you borrow money for an interest rate. Treasuries are considered the most risk-free if you hold them to maturity, but you can also lend money essentially to municipalities, to cities and states. You can lend money to corporations. And you can even now do peer-to-peer lending, though that would be considered alternative. Anything of a bond that can be traded on the public markets. You can go in your brokerage account, like a Fidelity, Schwab, whatever, Robinhood, and you can essentially buy bonds in one way or another that way. Now, I say that's the most common because a lot of people don't manage their own investments, and I'm going to do another video about the ways in which you can invest your money. But if you're going to have a financial firm help you manage your money either by having a human being that you talk to put together a portfolio for you, or nowadays if you don't have enough money, you would commonly have the robo-advisor version from any place do investing for you. And they would put together usually a combination of stock and bonds. And historically, the plan is however old you are, that's the percentage of bonds you have. So if you're 30 years old, you'd have 70% stocks, 30% bonds. And that's probably the number one most common way your money would get invested. And usually the goal of an advisor or a service is to get you, on average, about 7% compound annual growth over time. Some years it'll be negative, some years it'll be 20%, but usually that's what people are shooting for. And that's, considered like average risk based on age. And risk tolerance is yet another video we'll talk about that. Some people say, hey, I don't want to have the bond component. Bonds don't pay enough money. They're paying more these days right now, early 2024. But, in the last 10 years, bonds haven't paid much. And people say, it's just not worth to have your money there. You got to go riskier and you got to have all stocks. Stocks, historically, the benchmark people use to say whether stocks, are performing well or not is the S&P 500 index. And I'm going to do a video about a glossary of terms, so I'll put that and hopefully link to that in this. But if you heard that term, the S&P historically for the last 100 years with reinvested dividends has produced about a 10% compound annual growth rate. Depending on the year you give that calculation, it might be more. I think towards 2015, I think it was maybe averaging more like 12%. I'm sure if you made that calculation in 2009, it would have been 8%. But on average, 10% is kind of a high-end expected return for a stocks and bond portfolio.